Thanks, Tamanna, for that. Let me welcome on board Mr. Satyanarayana Raju, who's the Managing Director and CEO at Canara Bank, to talk to us about Q1 FY25 numbers. First off, sir, with regard to margins, the sequential shrink has been extremely large, much larger than what the estimates seem to suggest. So just talk to us about what's happened there, because yields also seem to have fallen a little bit. So could you give us perspective on both of those aspects?
Yield on advances slightly down is not because that the yield pressure is there. So whatever it is there, yield that's we are able to maintain it. It is only because of the regulatory guidelines for from 1st April 2024 onwards, that treating the penal interest instead of interest portion, it has to be treated as an other charges. That has caused some shifting of almost 150 crores from interest income to the other income. That's why this yield on advances has shown slightly the small dip in that. Otherwise, there is no problem in yield on advances. It will continue to gain at that level only, but may not be showing a much improvement there, because already we feel that we have achieved the maximum, because we have already repriced the existing low yielding advances with high yielding advances. Even the current quarter also we did 22,000 crores. Last quarter also we did approximately 20,000 crores. So the yield side, I think there need not be any worry for further reduction. It may maintain at the existing level, but the cost of deposit definitely a worrisome. And it's every quarter, even we expected that this first quarter it may little bit softening may happen. During the first fortnight of April, we have seen that softening, but thereafterwards again it has started increasing the cost. Nowadays, the incremental cost, if you go for the any bulk or CD in the market, you are supposed to offer at around 7.8%. That's too high for any of the deposits. But rising the deposits is not a concern for the public sector banks because of their sovereign background. But cost of the deposit is definitely a concern, unless otherwise the liquidity in the system is improves. This cost of deposit definitely plays a vital role in defining the margins. That's the major reason you can look at that the cost of deposit of our bank has increased from 5.5 to 5.70. It's a 20 basis points. That has caused further our NIM reduction from 3.05 to 2.90. However, this we predicted earlier itself. We have given in our guidance last time when I understood the annual results. We have given a guidance of our NIM at 2.90, but it may likely to improve to 2.95. Even now, I am reiterating that generally the tendency is first quarter may you will see a little lower NIM, and gradually second, third, fourth quarter slightly improvement will be there in the NIMs. So that's why we expect that the next 3 quarters, once this entire whole financial year, we may settle down our NIM around 2.95.
Okay, sir, but could you give us the rationale behind why Q1 is likely to see the largest NIM contraction, and why this reversal, or rather increase in NIM going forward, given the kind of deposit growth pressure that's already there in the system? Give us the rationale for that, please.
One is the cost march, whatever the cost we have taken, raised the deposits to meet the requirements of the credit. Actually, credit dispensation will be more in the second half of the financial year. Generally, you are forced to raise the deposits in the second half of the financial year. That impact will be there more in the first quarter. That's why your cost of deposits will be more on the first quarter. The second one is the NIMs calculated based on the average business. When you move towards the second, third, fourth quarters, this average deposits and average advances impact will come down slowly. That's the reason actually your NIM slightly may improve in the next 3 quarters.
Sure. So, let me switch over to growth from margins. What's the guidance with regard to FY25, both on deposits as well as loans? I appreciate that your LDR is fairly healthy, which is loan to deposit ratio is fairly healthy, but talk to us about what the guidance is.
Actually, the liquidity problem and importance of the deposits we realized in the initial stages of last financial year itself. We are the first banker. We announced various measures targeting the deposits growth in the first week of the last financial year. We continued the same innovative initiatives and products we announced in the first week of this financial year also. That's the reason even the last year among the peer banks, Our deposit growth is our bank is the only bank has shown the double digit growth in the deposits. This first quarter also we are able to show that our deposit growth is better than the advances growth. It's not that the advances are not growing. Advances corporate side 22,000 crores low yielding advances we are shed. We ask them to repay it. These are all the short term loans. We are not renewed it. That amount we are using in our liquidity and so that we can earn other interest income in that. That's the reason we are doing this. This because of our focus more on deposits compared to other peer banks. We are able to show a double-digit growth in the deposits. Our thrust is continuing there because we already reached 73%. Maybe there is a cushion to reach up to 74 to 75% in the credit. But first last March quarter and this first quarter, we aimed for repricing our existing corporate portfolio, which we have completed that exercise. And now that our corporate portfolio yield is reached to 8.29%, this is very much comfortable for us. The next 3 quarters we drive for the growth that will reflect in our credit growth. Definitely credit growth will be above the more than the 10% because corporate so far even after repricing 22,000 crores we are able to show more than 1% growth in the first quarter. Our RAM credit is growing near to the 2% in the first quarter. So that's why year on year, if you see that our RAM last year also has grown around 14%. This year also we are growing about 12% in the first quarter itself. So definitely with this growth, we may aim at 11 to 12% in the next 3 quarters. Maybe slowly it may improve to 10, above 10%, then 11% and 11.5%. By the end of the financial year, we may be at between the 11 to 12%. That will help our NII also.
All right. And so, sorry, your deposit growth guidance, if there is one?
Yes, sir. That's what actually I'm telling that even the last year, our regulator has given a guidance that the better under such liquidity conditions and at least 20% of the domestic savings are diverting to the mutual funds and the equity side. This is the time the bankers should focus on the liability mobilization. That is the guidance given by the advice given by the regulator also. That we have taken on the right spirit. We have focused more on that. Though we are given a conservative guidelines, last time we are given at 8%, but we have grown at 11%. This time also we are given a guidance at 9%. We already in first quarter itself, we have grown more than 11%. So we continue to be in the double digit. We want to incremental CD ratio, whatever it happens, it should be at least 100%, not more than 100%.
Okay, point taken. So incremental CD ratio to be at least 100%. Now let's talk. So now talk us through corporate. What's the kind of traction you are seeing in corporate capex, especially on the corporate capex cycle, and what growth can we expect from corporate, or how much will corporate contribute in terms of growth?
One is petroleum is only because of that 1 year back, 1.5 year back, during that Russia-Ukraine war when it has started, overseas branches have lent against that Indian public sector petroleum companies on short-term loans. Those loans, that is only a short gap arrangement. Those loans, the requirements, once the requirement is over, period is over, they are repaid it. That is the reason that is the trimming has happened. It's not that any intentionally we have done something. But the NBFC definitely we are trimmed intentionally only. One is because we are cautious in selecting the NBFCs. We don't want to lend below the A-rated NBFCs. Also, we don't want to compromise on the price for the sake of top line. And the second one issue is all the central government NBFCs, some of the NBFCs, they are all enjoying at a very low rate of interest, which nowadays it is not a cost effective for the Canara Bank. That's why we have taken a call to better not to renew these loans. So we have withdrawn those short-term loans, credit lines to those guys. All these are fallen in the NBFC. That's why the NBFC figures have shown down in that, so from 144 to 118.
All right. Cooling off, especially in the NBFC segment. Very interesting. Thank you so much for all of those insights, Mr. Raju. It's been a pleasure speaking with you today on the Q1 numbers.